Okay. Hi, good morning, everyone. I'm Albert, and welcome to Siloam's full year 2025 earnings call. I'm joined today by our CEO, Ibu Caroline Riyadi, our President Director, Bapak David Utama, our CFO, Pak Daniel Phua, and our COO, Pak Sumantare. Following the management presentation, we will also have a session for Q&A. So meanwhile, please drop any questions you may have in the Q&A sections. And with that, let me share my screen and I will pass the floor to Pak Daniel.
Thank you, Albert. Good morning, everyone. Very delighted to be able to share the full year results with you. As most of you already picked up on the announcement this morning in regard to first rate, I'm sure there'll be a lot of questions on that as well. Albert, can you share the screen, please?
Yes, can you see my screen?
Yeah, okay. So let me just go through the financials initially. I think I would say it is a exciting financial results that we would like to share with you. If you look at the movement in regard to the fourth quarter of 2025, it is a significant improvement upon last year. We see EBITDA growing by 26.2% for Q25 versus for Q24. And we are also seeing that the revenue improved by 10.9% and the net profit improved by 30.6%. We've always stipulated in the 2025, we need to look at the performance in two halves. Yeah. The first half of the year, it is relatively flat. You will notice that for the first half of 2025, revenue went up by about 1.5%. And that is predominantly due to various external factors, insurance adjustings, a much higher base in the 2024, and also various efforts that we're going through in terms of transitioning to a archetype strategy. So by the second half of the year, what you're seeing is that the archetype transition is largely stabilized. Our discussion arrangement with insurance is largely settled and is more back to normalcy in regard to business performance, which is why you notice on the second half of the year, revenue actually improved by close to 9%. And more so, if you look at Q4 in particular, it is an 11% improvement year on year. So the way we see it, I think Q4 really is more representative of what the steady state should look like going forward after all the initial transitions that happened in the first half of 2024 and various external events hitting us in the Q3 of 2025. You would notice obviously that from 3Q to 4Q, the improvement is obviously not as significant as compared to 2Q to 3Q. But then again, that is largely due to lower productive days in fourth quarters, Christmas holiday and so forth. So when you factor in the productive days, fourth quarter's revenue per productive days that we calculate is actually improved about 5% compared to 3Q 2025. So what we're seeing is that quarter on quarter, results continue to improve, driven by the execution of the archetype strategies that we've been telling you so much about. And we are finally seeing that is translating into real results that we can see in our operations. Moving on to the next slide. You would notice that in regard to our payer mix, we have articulated in the past that our strategy is to focus on growing revenue intensity, complexities, and also, especially towards the second half, we are seeing a strong recovery coming from the corporate and insurance sectors, which is why you're seeing that as of 4Q of 2025, the corporate insurance actually made up close to 53% in regard to revenue contributions, whereas the BBJS segment has decreased from over 18% down to about 16%. Again, BBGS has been growing, as you can see from this graph. But 4Q24 to 4Q25, it grew by 0.7%. But corporate insurance has grown substantially more in comparison, by 17.5%. And OPE also grew by 6.4%. So as a whole, you see that as a result of that, the mix has started to shift towards more private as we continue to increase the complexities and acuity of the services that we provide. Now, when you look at the operational matrix, next slide, please, Albert. In regard to the cost management, I previously articulated to you that during Q1 and also to some extent Q2, there was some transitional costs due to the implementations of archetype strategy. You will see that that has largely stabilized coming into Q3 and Q4. Operating expenses as percentage of revenue has decreased from 30.4% down to 29.1%. But in 4Q 2025, but this is one of the lowest results we've achieved, and we do believe that that will continue to improve over time as well as a result of various initiatives that we've executed internally, and as a result of us pivoting to the archetype strategy as well. EBITDA margin, similarly, as you can see, the underlying EBITDA margin in here has improved from 30% in 3Q 2025 to 30.8% to 4Q 2025. And the underlying net profit and margin has similarly seen improvement in that as well. Moving on, the throughput has stayed largely stable from quarter to quarter. And we have seen that, for example, outpatients is steady, 1.2 to 1.1. Inpatients is also largely stable. Therefore, a large part of the revenue growth that you're seeing is driven by the improvement in revenue intensity. Next slide, please, Albert. So if you look at the revenue intensity in regard to ARPOP, for example, 3Q to 4Q 2025, that has improved by 4%. And in 2024 to 2025, that has improved from 3.4 to 3.59 B as well, a 5% year-on-year improvement. Now, again, this is linked in to what we have been telling you consistently, that the strategy from Siloam is to focus on the increasing complexities. We've been investing heavily, for example, in robotics, in being able to bring in the best specialists, for which Ibu Carol and Sumanta will tell you more later. But this, we believe, will be a strategy that will anchor the future growth for Siloam. As you can see, a lot of the growth this year in revenue has been driven more from revenue intensity instead of throughput growth. Looking at the cash flow has been very stable as well. Working capital days is steady at 5 working days in 2025. And we see operating cash flow improving to close to 2.5 trillion, which gives us a lot of momentum to be able to invest in future expansions, equipments, and so forth. I will pass the time over to Sumanta to give you a bit more update in regard to what's happening with our hospitals network and some of the exciting progress that we have seen. Over to you, Sumanta.
Thank you, Daniel. Good morning, everyone. So as we entered 2025, we had faced significant peer-related and market-related headwinds. And this kind of continued from the latter half of 2024. And three main areas where we faced a lot of challenges. The first one was, of course, corporate and insurance was under pressure because of higher claim payouts and so on and so forth. So they were doubling down on cost control, restricting access, and so on and so forth. So that was one dimension. And we had to go through a period of very hard negotiations and discussions and so on and so forth. The second was a structural issue within insurance, where there was a massive shakeup in the group insurance market because of several key accounts trying to control their costs, etc. So as you would be aware, many of the smaller corporate group insurance kind of shut shop or even exited the group insurance side of business. So there was a shakeup while things have stabilized now, but that was how we had entered the beginning of the year. And then thirdly, we were seeing movement from OP to BPJS and so forth. However, despite all these challenges, we remained very focused. And Daniel mentioned about the archetype strategy, which we call the network strategy, because now it's stabilized to an extent. And we focused on the execution and sustaining growth. So we accelerated our archetype or network transformation, as we call it, to better align services, improve efficiency, and strengthen competitiveness. So we doubled down on that and focused on the network transformation. Next, please. I would like to take a moment to talk about our brand identity transition, which you will see the importance of that as we go along. So this is only the second time we did a brand transition in the history of Siloam. The first was in the year 2000, when from a single hospital, we became a group of hospitals. So and 25 years later, we again changed the brand identity. So it kind of demonstrates that how important the network or the archetype transformation strategy has been for Siloam as a key lever going forward and building the next level of growth, because there's this proper 25 years gap between the change of brand identity and how it plays out across the networks. I'll talk in the subsequent slides. Next slide, please. So we transitioned to, and this we have spoken about in the earlier calls, into 4 networks, 2 of them premium specialist and premium generalist, which are essentially focused on building clinical excellence and adding specialist doctors, adding technology, and so on and so forth. And our 2 value networks, which is Value Seeker, which is our mid-market play, and Community Generalist, which is our BPJS play, where the entire focus is on operational excellence and increasing throughput. While we changed the overall brand identity, we also now started from Q4 onwards to transition into also network level brand identities. So the premium specialist, premium generalist are moving into new brand identity, which they will be called Siloam International, because we are aspiring or are in the process of transitioning to a clinical equity at global levels, at international levels. And this is what we wanted to also demonstrate to our patient base and customer base. The Value Seeker mid-market offering continues to be Siloam, where our BPJS offering, there is a transition to Rumah Sakit Umum RSU Siloam, reflecting the congruence with the market in which it operates. Next slide, please. So in the premium networks, we focused on a few things, and we have been very, we have doubled down very deep into these areas. First is, enhancing clinical equity, and we did it in 2 parts. The left side, if you see, we added a lot of specialists. So over the 4-5 quarters from December, if you look at it today, by end of next December, we almost increased 70% specialized doctors. So that was the quantity side of things. On the quality side, we had added tremendous amount of global partnerships so that we could learn from them, get our doctors trained, and move up the clinical equity. So from a clinical standpoint, both from a quantity side and a quality side, we really doubled down and built up, especially in our premium networks. Next slide, please. In addition to that, we really, and Daniel mentioned this, went ahead in deep into a fairly good amount of cutting edge technology. Many of them the first Da Vinci XI robot in Indonesia, the first brain robot in Indonesia, the first CT Linac in Indonesia, and so on and so forth. And this is something we continue doing. The third part, which we have always focused on Congo Euronephro as our key craft groups. So we double down on the thought leadership on each of these. There are 5 summits which we hold. We started full 5 last year, and now we'll continue every year, whereby the cardiac, oncology, digestive, Euronephro, and neuroscience summits, which has a significant amount of international speakers, a lot of national speakers, and over 600, 700 participants, and growing at every level. So the focus has been on specialist, addition of specialists, upgrading our specialist skills, adding technology, and maintaining thought leadership. So this is how we have largely been driving our two premium networks, which I mentioned about. Next slide, please. And this, as we kept on going, we have been recognized across various forums for this. Siloam, Newsweek recognized Siloam as the 24th most trustworthy company in the world in the healthcare and life science segment. Our hospitals have won Best Hospital in Asia Pacific by Newsweek and various other awards. So that is an external validation of the kind of stuff which we're doing towards driving clinical equity. Next slide, please. And not only the validation, it has also showed in numbers. So, Daniel shared the kind of year-on-year growth. I'm kind of giving you a quarter-on-quarter review of how we entered the year and how we exited the year. If you look at revenue grew by over 13%. Corporate insurance, which we, like I mentioned, there were significant headwinds. We were struggling at when we started the year, but by the time we exited the year, the overall quarter-on-quarter growth, Q4 over Q1, was 16%. OP, we maintained the growth. As a result, it reflected in almost 24% EBITDA growth. Now, I'll also give a little flavor on how key metrics worked on each of these two broad segments, and I'm not getting into specific of each network. So our premium networks, where the focus is on clinical equity, we managed over 4 quarters to increase our ARPOB by double-digit numbers. So that is significant. That's what all the earlier slides which I talked about kind of leads into. While the value networks, which is about operational efficiency, adding more throughputs, we managed to increase the occupancy by over 6% over the 4 quarters. So in sum, we see the results of our network strategy, which allows us to really unlock value and to drive business segment by segment. And like I think I mentioned in the last call that I don't know of any healthcare organization which has done a segmentation based on patient segments, but that is something we took up at the beginning of the year. This is the first full year of network operations, and we are seeing significant value unlocking through this network strategy. That's all from my side, and I'll hand over to Ibu Carol for the next section.
Thank you, Samantha. Nice to have all of you join us for today's earnings call. And as you can see, 2025 was not without challenges, but the team worked very hard, and you can see in the results, and it was an incredible turnaround year. I'm going to draw your attention to our next-gen Siloam strategy that has been presented before, and we will be showing this a lot at the risk of sounding a little bit redundant, because it is because we are focused on the execution, and we will continue to provide updates on the next-gen Siloam strategy. So Samantha took us through the supercharging archetypes, updates, and noticed how it has moved from concept to plan to execution, and now you can see the results. So that's how we want to move in our strategy, and we want to keep a razor-sharp focus, but not just as a framework, but really to a point where we can show you how it is impacting our business, our people, and our operations. I will spend a few minutes after this to go through the people first pillar and give a little bit of an update on the Go Beyond. And you may have noticed a new pillar in our NGS. Previously, we've presented 3, and we've added a 4, which is the hospital of the future. We live in unprecedented times when artificial intelligence, robotics, hyper-personalization are not science fiction. So we've asked ourselves, what does this mean for the hospital? What will hospital services and operations look like in 3 years? How will medicine change because of it? We have put together a very deliberate plan on what makes sense for Siloam, and we have started executing on this pillar over the past year, and we look forward to updating it and sharing it with all of you during our next call. I'm going to move into the people first pillar. We've created a framework for the people first pillar because people first can mean many things. So it is important to clearly define what it looks like. We, as a people first organization at Siloam, we empower our people to thrive and achieve their best by building a supportive, growth-oriented, and merit-based work environment. So we want a talent-dense, high-performing, motivated, supported workforce because this is critical to quality patient care. It is critical to growth, and ultimately, it is critical to the success of our strategy. Siloam is becoming a very large matrix organization. We now have 17,000 employees and 3,000 specialist doctors. And if we are not careful, we will lose the agility that we need to respond quickly to trends, opportunities, and the needs of our patients. So this starts with the right organization design, a fit for purpose organization. Then moving into talent development, having the right talent, and then making sure our talent is engaged. We have started measuring employee engagement survey with a third-party vendor, and we will be doing this every year. It's also, as you know, benchmarked to industry, to country, to region. So not only will we be monitoring our progress, but we're going to see how we stack up against our peers. The people first pillar is not just a nice framework, but we intend to bring it to a point where we can see real changes. And most importantly, the people in our organization can see real changes. One example of an initiative we've done on the people first strategy is a nursing transformation. The nursing transformation is the biggest bulk of our workforce. We have 7,000 nurses, and the nursing population is not a homogeneous population. It is quite diverse. We have outpatient nurses, inpatient nurses, ICU nurses, hemodialysis nurses, operating theater nurses, and they're all very and highly technically trained and empowered. How do we make sure every single nurse has the right training and the right empowerment for them to take good care of our patients? So we've mapped out all the nursing competencies and mapped it to every single nurse category, put a training program in place, an assessment program in place, linked it to compensation and benefits, and also mapped it towards a career progression. And so this not only is good for us and our patients, but good for the nurses that are in our organization as well. So this is one example of one of the initiatives we're doing in the people first pillar. And we will continue to update on people first. And go beyond, we have two large programs in this pillar, which is growing our clinics network and our lab services. Why? Clinics and lab, because we believe both these care delivery models are strategic to the Siloam ecosystem and in line with patient care trends. Care moving out of the hospital into communities and closer to home, and also advancements in vitro diagnostics, which really means lab, enabling more accurate and timely diagnosis and curative intervention. We have 3 categories of clinics that and 2 we've been operating for quite a while, which is the primary care clinics and the corporate clinics, where we partner with corporates, and oftentimes the clinic is on site. And this year, we're going to be launching a new category of clinics, which is a specialist clinic, focused on personalized, efficient patient care, the first one being in Senayan. Next, on the lab, we have spent the past year building the foundation of our lab operations. Now, all our labs operate with one centralized lab information system and connected to our online booking and referral system as well. And so this is the right time for us to bring in additional capability. And we're very pleased that we have Vinco, who has joined us who brings extensive knowledge and experience in the lab business globally. Experience from Dr. Lau, Path Labs and Asian Labs, Geniflow Labs. So we know that he's going to bring an expertise and be able to grow our lab business with us. And again, we will be providing updates on the lab project. The last one is on our pipeline. Oftentimes, we like to share this update from time to time, showing that we're also investing and planning for future growth. But I think that it's also nice when we're not just updating construction in progress, but we're also showing how the hospital is ramped up. So I have included a one-slide update on how our new building in Siloam, Gubeng, which is called the Makta Riyadi Center for Advanced Care, next please, has ramped up in the first 6 months of operations of the new building. So driven by additional capacity, which is bed capacity, operating theater capacity, rehab capacity, all across hospital services, and revenue intensity through new capabilities such as cardiovascular surgery, orthopedic robotics mentioned by Samantha. And you can see also the growth in revenue and the growth in EBITDA. This is just one example how our investments in new facilities are leading to growth in revenue, profitability, and most importantly, better care and access for our patients. So that's my brief update on the strategy. So hopefully you can see a consistency throughout the quarters of how we're executing this. And so we can deliver growth, not just today or the next quarter, but also growth for the future years as well. With that, back to Daniel. Oh, sorry. Update from Pak David, very important update on our ESG progress. Sorry, Pak David, over to you.
No worries. Thank you, Bu Carol. Good morning, everyone. I think as what Bu Carol has shared, Pak Daniel mentioned all the facts and Pak Sumanta talked about the commercial. So 2025 has been a great year for us. It's not just a growth year, because if you can tell from all the presentation, we are no longer putting effort into volume growth. It's a reset year where Siloam is shifting from a volume-driven expansion to equity-driven, margin-led, and structurally scalable growth. And also, if you listen to what Daniel talked about the balance sheet, it's strong. We have done all the heavy lifting. Now we're entering a phase where the balance sheet converts into higher return of invested capital, stronger cash generation, and capital deployment optionality. So now, when it comes to ESG, in Siloam, ESG is not just a compliance exercise. It's how we deliver better clinical outcomes, stronger workforce productivity, and long-term sustainable returns. So if you see as an example, I'm just highlighting a few of the things that we do. Sri Lanka, for example, has been a 2-year plus program where we have consistently promoting for early detection on breast cancer. And we are providing free of service, and we have scanned north of 50,000 women screened, where 39 of Siloam hospital units are participating, with 63 different screening locations in 30 cities and districts. We have conducted health talks to educate the communities and the people that we reach with 50 plus communities. In fact, with Sri Lanka, we've earned the Muri record, where we are the largest series of breast cancer ultrasound examination for 3,000 plus women in 7 consecutive days, right? So this is the type of commitment that we do of how we promote health. So next, which is equally important, is ESG. As what I said, it's just not a compliance. But if you look into what we have achieved in 2025, we have moved a year before from a bronze to silver, and that make us to be the top 15 companies assessed by EcoVadis globally, and makes us the top 3 company in human health activities industry. So if you look into EcoVadis, the framework of the core themes is around environment, labor and human rights, ethics, and sustainable procurement, where all the graphs showed you that the improvements are quite significant. And we are not stopping here. Actually, hopefully, this year we can move from silver to gold, right? So that's why I said ESG for us, it's not just a compliance exercise. It shows how we deliver better clinical outcomes, stronger workforce productivity, and long-term sustainable returns. So hopefully that gives you a glimpse of what Siloam is. And next, I think Pak Daniel is going to close the session with all the questions that most of you guys have. I'll pass to you, Pak Daniel.
Thank you, Pak David. Yes, we leave this to last. I mean, most of you would have seen the announcement coming out this morning. Basically, we have been telling you for some time already that we intend to execute the buyback of 14 hospitals from First REIT, for which the facilities had already been arranged from last year. So we're happy to announce, after all the discussions, this will be going ahead. The acquisitions will be divided into 2 tranches, of which tranche 1 will be 8 hospitals that's involved, and then 6 hospitals will be done in the second tranche. The aggregate sum of the transactions will be about 9 trillion. This is an implied 2.3% premium to the property valuations that is on the First REIT's books as of 31st of December 2025. Now, this acquisitions is significant and strategic for Siloam. I think I've articulated the reasons before. I do want to repeat some of the key reasons why this is actually very important. First of all, by acquiring our own hospitals, we make sure that basically all upsides stays with Siloam. Otherwise, as you know, we currently paid about 6.4% of revenue, going up to 6.5%. Every year, the better we do, the more then flows out in terms of rental. And as you can see, Siloam's performance over the last 3 to 5 years has been significant. There has been significant improvement in it, which also means that as a result of that, due to the fact that the rental is pegged to a percentage of revenue, the rental has also been increasing significantly. So, and these 14 hospitals, as you well know, are all strategic hospitals for Siloam. By having full control over it, it means that we don't have to go back to the landlord anytime we want to do an extension, renovations. We have full control over being able to deploy the capex, looking at how to improve it. We've been telling you previously, for example, about our premium strategy. We want to go premium. And a number of these hospitals will be going through expansions. For example, Kebon Jeruk, for example, Livo Village is having a new building added to focus on oncologies. Having full control over these strategic assets will allow us to deploy capex more effectively going forward. And a lot of these property values on the First REIT's books, as you can appreciate, is tied to the value of the lease. And the value of the lease is then tied into the revenue of Siloam. So in a sense, what we're saying is that these properties becomes more valuable as the performance for Siloam improves. So it is also logical, therefore, for this asset value to be now embedded into Siloam's books, as opposed to obviously, the appreciation in the property value now sits in First REIT's books. There is definitely long-term financial benefits. I've shared with you before, compared to our peers, which largely own their own hospitals, which depreciate their hospitals over time, over 20 years. Depreciation would come down eventually to 0 at the end of the 20 years. But obviously, because we are tied to a leasing arrangement that is tied to a revenue, our revenue goes up every year, and therefore see the PSAK impact in regard to the depreciation also goes up every year. So instead of depreciations, coming down, ours goes up year on year. Now, by buying back our hospitals, we would then be more comparable to our peers, whereby you will see depreciation start to come down, and therefore by default, margin would improve year on year as a result, as opposed to margin being decreased by the increased rental, offsetting the improvement that we get in revenue. So we are very happy to announce that this is happening, and we are very excited about this as well. We do believe that this not only brings long-term financial benefits to Siloam, but is also strategic for the future growth of Siloam. Maybe from that, I would jump to some of the questions some of you already posted. Most of you probably have some common questions. So let me kind of try to address that in here so that it could help you with your model and calculations. First of all, why is it done in two tranches? The two tranches is done such that there is a transition. I think from first rate position, it also allows that for the DPU transitions to be more stable, because after first rate dispose of these assets, the funds needs to then be redeployed to other assets. I think this is a logical way in order to have a smooth transitions. Tranche 2 will be a put options whereby the value is now fixed. Tranche 1 is expected to be executed. I think if you look at the announcement that came out this morning, it should be executed by August. Obviously, it is still subjected to shareholders' approval on both sides, and the necessary regulatory approval. But otherwise, we do expect tranche 1 to be executed by August of this year. The purchase will be executed by the facilities that we already got in place last year. It is a floating rate based on Indonesia. So latest, I think, is about 6.3% in regard to the interest rate. But as I said, that will be floating, so that could come down. The annual rental that we paid for these 14 properties, net of VAT, is about 500B a year. The accounting impact from a PSAK perspective is also roughly the same, about 500B a year. So I think that should allow you to do some of your simulations and calculations. Maybe let me address another question that I know most of you will be asking as well. I mean, what is the guidance outlook for 2026? As I mentioned, we are very happy with how Q4 is performing. However, as you can all appreciate, there's a lot of uncertainty from the macroeconomic positions, for which internally we have also been preparing for and discussing various business contingency in order to address the macroeconomic flow on impact that could happen due to the various events that is transpiring across the world. But barring obviously the unforeseen circumstances that is outside of our control, I made it quite clear that Q4 is really what a normal quarter would look like. So if you were to look at that to build your model for Q4 year-on-year performances, should be what a normal state would look like. But obviously, with various external events, that it's really a judgment call as to how that would affect things. But we are seeing that the results in Q4 at least is carrying over into the first quarter of the year. So we do believe that the strategy that Siloam has implemented in 2025, moving into the archetype, is that definitely steering the boat in the right directions. We do believe that we just need to be persistent in executing the strategy that we have put in place. With that, I would end my presentation for today, and I will go over to Q&A. Okay, Ismail, I think I addressed your question in terms of the timeline for the payment. Obviously, the first tranche is subject to all the necessary approval, should happen in August. Second tranche, at this stage, we don't have a firm timing yet. When we do, we will definitely share that with you. Outlook, I think I've mentioned that. Strategy with the lab business, maybe by David, you want to take that one?
Let me give you a highlight of the strategy on the lab business. Obviously, Bu Carol announced that we have Winkle on board with us. We are very pleased to have him, very experienced, almost 3 decades of experience running the lab at a scale of significant. But for now, what we are doing with the lab business, actually, there are two approaches. One is definitely structuring the organization with the capability that we believe needs to be in place from the operation, from quality, from certification, and whatnot. So that's part of the structure. But from a business standpoint, what we see immediately in the short term, there's the B2B from an internal, especially where we have to maximize a lot of potential within our B2B internal that is within the Siloam network, be it the clinic, be it the hospital. And then what we also immediately are building on the capability is the B2B external. A lot of people talk about capability outside that needs support, and we see this as a big opportunity. If the question from the floor is, are we moving into a retail a lab? For the time being, that's not in the play yet, but potentially we'll see once we maximize on the both B2B internal and external. If we see the potential to move to pivot into retail, that's some consideration we could do. But the way we see on the B2B internal and external, the opportunity is still large. We are probably today by revenue is already the number 2 player lab in the country, but we just have to make sure that we maximize on the potential, and that's why with Winkle on board, we see this as tremendous opportunity of setting the future of our lab business. Back to you, Albert, for the remaining questions.
Daniel, I think we still have some remaining questions if you would like to take those.
Yeah, let me address some of those. A-loss, a lot of the A-loss increase is really coming from the BPJS segment due to the change in the mixed cases. But if you look at the movement, I don't think it's out of the ordinary as well. It does move between the 3.1 to 3.2 range. I think there's still a lot of questions related to first read. I believe I've given you all the key numbers that you need to calculate your simulations on the EBITDA, NPAT, and gearing and so forth. As you know, we took out the syndicated loan last year. We already announced all that. What I do want to emphasize again, like short term, depending on how the interest rates swing, the interest payment could be higher than the rental. But again, as principals get repaid over time, they will come down. But initially there will be depreciations, but depreciation again will come down over time. I think we need to look at this from it will be strategic and long-term value accretive. But obviously there will be some initial transitional period depending on what the interest rates look like. But I think more importantly though is our ability to then having full operational control over these properties. And considering that if you look at, we have also been investing significantly over various expansions. You would definitely see, for example, Kebun Jeruk, Lippo Village, Bali, Kupang, Purwakarta. Actually, all the properties in here, we have active plan to build upon these hospitals and expand. And these are hospitals that are already doing very well. And we do believe that we should build upon the success, as you have already seen what we did with Surabaya, with the Gubeng that Carol shared with you earlier. We bought that back, I mean, from first read, 3 years ago. And after that, we were able to expand and being able to build on the momentum. So you'll be able to see more of that as we continue to build up the capacity and capability of existing hospitals that are already doing very well. Other than that, I think, Ingrid, I've covered your other questions. Why structure it with a put option? So this is, as I say, to allow this to be carried out in 2 tranches. We just believe that this will be allow time for transitions, allow time for first read to deploy its funds allow a more stable transition in regard to DPU for first REIT. So we do believe that that is logical. But RE coming back, I think I mentioned we do see that 1Q is sustaining the performance that we see in 4Q. But going beyond that, obviously, there's a lot of macro uncertainties beyond our control, but we are very happy at the success that we're seeing from the archetype transformations. We are seeing it's not just the performance, but the matrix that we are setting for each of the archetype in regard to the target patient profile. We are seeing that those matrices are being met, and they are all trending towards the right direction in order for us to have a more differentiated service offering that fit the need and requirements of a particular customer segment. So I think that's going to be a key anchor for the growth, along with obviously all the expansions and the CapEx that we're deploying to our existing hospitals that are already doing very well. The depreciation for the 14 hospitals, well, I guess you can calculate, it will be, at the moment, it is a PSAK 73 calculation. But for the first REIT properties, is roughly the same as what we pay in regard to cash, so roughly about 500 B a year. Now, going forward, after we buy back the properties, I guess you can calculate it yourself. I mean, it's a 20 years depreciations, and you can slot that in. So that should allow you to prepare some models based on that.
Okay, I think that's all of our questions. I mean, if there are no more, then that brings us to the end of today's presentation and today's call. Thank you everyone for attending the full year 2025 Siloam earnings call, and see you on the next earnings call. Thank you again.
Thank you, everyone.
Thank you, everyone.